Picture this. You're a thriving business with a global workforce. It's time to pay your international employees, but the process is far from straightforward. Welcome to the world of cross-border payroll, a realm filled with complexities and challenges. It's like a game of chess, where every move demands careful thought and strategic planning. Consider currency exchange rates. They're like the weather, constantly changing, and these fluctuations can significantly impact the value of payments. Then there are the legal and regulatory requirements. Each country has its own set of rules, and keeping up with them is like trying to catch a train that's always leaving the station. Taxation rules. They're a labyrinth of their own, varying widely across borders and often as clear as a foggy morning. And let's not forget about the limitations of banking systems. With different protocols and procedures in place, it's like trying to navigate through a maze with no map. But the challenges don't stop there. Compliance issues, fees, language barriers, time zone differences. These are just some of the hurdles waiting in the wings. Even tracking payments can be a Herculean task, not to mention ensuring data privacy in an era where information is as precious as gold. Interestingly, the COVID-19 pandemic has turned this complex process into a necessity rather than an option. A survey of small and medium-sized enterprises found that 60% increased their use of cross-border payments during the pandemic. It's like being thrown into the deep end of a pool and learning to swim out of sheer necessity. So, as businesses continue to expand globally, navigating the complexities of cross-border payroll becomes an inevitable part of the journey. It's a challenging route, but one that's essential for the success of any global enterprise. It's a game of chess indeed, but with the right moves, you can certainly checkmate. Now let's take a sharp turn and dive into the world of fintech. Have you heard of embedded finance? It's a term you might want to familiarize yourself with. Embedded finance is all about integrating financial services into non-financial platforms. It's like a chameleon, seamlessly blending into its environment. It's the banking service on your favorite online shopping site, the insurance option in your ride-sharing app. It's finance, but not as we know it. Europe is leading the way in this space, thanks to its cross-border trade regulation, multi-currency banking, and open banking policy. Non-financial services companies are starting to offer banking services beyond online payments, and the sector is gaining serious traction. Just to give you a sense of scale, embedded finance is expected to be worth $7.2 trillion by 2030. Yes, you heard that right, trillion with a T. And it's not just about future potential. The sector is predicted to generate $230 billion in new turnover by 2025 in the US alone. A few startups are already making waves in the embedded finance world. Take Primer and Fidel, for instance, both backed by prominent investors and making a name for themselves in the sector. The European market is particularly ripe for investment due to its advantage in open banking laws and embedded payments. It's a bit like a gold rush, with venture capitalists vying to stake their claim, and at the heart of it all, the development of financial services infrastructure and the integration of APIs. This, along with the rise of enterprise marketplaces and insurance products, are key steps in the embedded finance process. In essence, embedded finance is revolutionizing the way we perceive and use financial services, making them more accessible and convenient for everyone. From the complexities of cross-border payroll to the rise of embedded finance, it's clear that the financial landscape is evolving at an unprecedented pace. As we stand on the precipice of a new era, the future of finance is set to be shaped by a number of key trends and developments. Picture a world where embedded finance becomes the norm, with non-financial services companies offering a range of banking services beyond online payments. By integrating financial services directly into their platforms, companies can streamline transactions, improve customer experience, and open up new revenue streams. The potential for growth in this sector is staggering, with the sector predicted to be worth $7.2 trillion by the year 2030. Meanwhile, cross-border payments, once a thorny issue for many companies, could become smoother and more efficient. Advances in technology and regulatory changes could help to overcome the challenges associated with currency exchange rates, compliance issues, and banking system limitations. This would be a game changer for companies with international workforces, making it easier than ever to facilitate global trade and investment. And then there's the issue of taxation. With the rules becoming increasingly complex, particularly in countries like the UK, we could see a shift towards more streamlined and simplified tax systems. This would not only ease the burden on businesses, but could also lead to greater transparency and fairness in the tax system. These potential developments could have far-reaching implications for businesses, consumers, and the economy as a whole. For businesses, it could mean greater efficiency and profitability. For consumers, it could mean more choice, convenience, and control over their finances. And for the economy, it could mean increased growth and prosperity. We're on the brink of a financial revolution, and it's going to be fascinating to see how these trends shape the future of finance.